Hello students, I hope my voice is audible to everyone. Am I audible to everyone, guys? We'll just start in another 2 minutes. Yeah, guys, please tell me whether I'm audible or not to you. Okay, so let's start. Today's topic that we'll be going to do is capital budgeting. If you have any doubts in between the class, you can please ask me those doubts whenever you are facing any. So guys, first of all, what do you mean by capital budgeting decisions? We'll start with this particular thing. As far as capital budgeting decisions are concerned, I really want everyone to actually relate these type of decisions with a balance sheet. Balance sheet is one of the important financial statements which gives, if I draw it in the horizontal format, it actually demonstrates that what are the organization resources which the organization owns versus what are the organization liabilities or the obligations of the organization that it owes to other parties. So in the organization assets which is owned by the organization, there are two types of assets. One is non-current asset, another is current asset. Similarly, when it comes to liabilities, the obligations that the business organization owes to others, we are having three components over here: non-current liabilities, current liabilities, and equity share capital. Equity, which includes share capital and reserves and surplus. So guys, if you go deeper and analyze the components of a particular balance sheet, we know that organization arranges funds through financing activities, that means raising of loans in the non-current liability section and raising of equity by issuing shares. So these two components of non-current liabilities and equity relates to financing decision, which are also known as capital structure decision of an organization. As the name suggests, how the capital is structured, how the long-term capital is structured, what is the ratio of long-term debt versus equity, right? These are financing decisions. Next comes current assets and current liabilities. For the regular day-to-day operations, what is the working capital required for day-to-day operation? So working capital decisions are concerned with current liability and current assets. But when it comes to deploying the funds which have been raised through financing decisions into various assets or into investments that lead to growth and survival of the organization, then it is known as investing decisions, also known as capital budgeting decisions. How are you utilizing your capital into assets? What are the assets that you are owning? What are the investment decisions that you are putting your funds into? All of these relates to capital budgeting decisions, and these are also called as investing decisions. So if you are familiar with cash flow statement, we actually consider non-current assets and long-term investments under investing activities, and only those are capital budgeting decisions. One point that is very, very important here is that we do not only take the investments that we do, that means we do not only consider the purchase of investments, rather we also consider the sale of investments. That means investing decisions are concerned not only with investments which are done or the cash outflows which are done for investments, rather it also considers the divestment or divesting. That means sale of investments will also be considered as one of the investing decisions undertaken by an organization. I hope this is clear to everyone. So in today's class, we will be, evaluating the criteria as to, that needs to be followed while investing into non-current assets of an organization, which is one of the most important decisions that the organization has to undertake, right? So good morning everyone. If there is any doubt till now, please ask me, otherwise I'll move on. So guys, like as far as the capital budgeting decisions are concerned, as I told you that this relates to investments in the non-current assets. How should we actually analyze whether we should invest in a particular non-current asset or not, or whether this is the investment decision that I should take or not? For that, there are a lot of evaluation criterias. Right, so there are two sets of evaluation. There are two sets of broad categories. One is the discounted techniques and the other one is non-discounted techniques. So firstly, I'll be talking about discounted techniques or non-discounted evaluation criteria. Once it is done, I will move on to discounted criteria. Both of them are very important. So let's discuss them one by one. Guys, do you have any doubts till now? Anyone? Shibham, Abhishek, Amit, Ravi, Nikita, do you have any doubts till now, guys? I hope that everything is clear till now. Okay, so let's talk about non-discounted evaluation criteria techniques. So the first technique that is very simple, covered under investment decisions or capital budgeting decisions under non-discounted techniques, is known as payback period. As the name suggests, it is the period of time, or it is the investment. For an investment, the period of time that it takes to pay back the initial investment, or whatever you have invested, what is the time period which is taken by an investment to pay you back that much funds is the payback period. So there are two scenarios here. In the first scenario, let's assume that you are getting constant cash inflows from this particular project. Let's assume that you are purchasing a machinery. The cost of the machinery is, let's say, 20,000. This is the cash outflow that you are doing at zero period. Now let's also assume that this particular machinery, if you are forecasting the inflows from this particular machinery, you are getting 5,000 kind of inflows every year for the next 5 years, right? Cash inflow 1 to cash inflow 5 is 5,000 per annum. If you want to understand that what is the payback period, we will be saying like this, that we have invested 20,000 funds in zero period, or our cash outflow in the zero period is 20,000. This is the investment outlay that we have done. Now, what is the period of time in which I will be paid back this entire investment of 20,000? What I'll be doing is I'll be accumulating the cash inflows one by one. So in this case, the cash inflows from year 1 is 5,000. Cumulatively in year 2, I'll be getting 5,000 more, and cumulatively I'll be recovering 5 plus 5, 10,000 on a cumulative basis till the end of year 2. Till the end of year 3, I will be cumulatively getting 15,000, and till the end of year 4, I will be cumulatively getting a total of 20,000. So guys, period of time, that means payback period, will always be giving the answer in years or in months. In this particular case, since I'm recovering my entire investment at the end of 4th year, my payback period in this case would be 4 years. Is this clear to everyone? This is very simple. Let's do a different scenario where you are getting the non-constant cash inflows, right? So consider another example in which you are getting this kind of a question. Let's assume the cash outlay in the zero period is 20,000. Cash inflow in the first year is 8,000. Cash inflow in the second year is, let's say, 7,000. At the end of third year, it is 4,000. And at the end of fourth year, it is 3,000. Guys, can you tell me what is the payback period in this particular question? Yes, Shibham, Abhishek, Amit, Ravi and Nikita, please answer me. What do you think the payback period would be in this particular case, guys? Yes, hurry up. Tell me what should be the answer. Okay, so I am waiting for you to answer, guys. In this case, the payback period that we would be having is, we have to cumulate the cash inflows. At the end of first year, cumulatively, I have just recovered 8,000. At the end of second year, cumulatively, I have recovered 8 plus 7, which is 15,000 in total. At the end of third year, I have recovered a total of 15 plus 4, 19,000. But still, I have not recovered my entire cash outlay. Very good, Abhishek. The answer is correct. See, at the end of third year, we have just recovered 19,000, but our objective of getting a payback period is to recover the initial investment, total initial investment of 20,000. That means till the end of third year as well, we have not recovered it. That means payback period is more than 3 years. But after 3 years, if I actually accumulate the entire fourth year cash flow, I'll be getting 22,000, which is more than 20,000. That means my payback period is greater than 3 years, but less than 4 years. What I'll be doing is, I'll be saying that my payback period is 3 years, but after 3 years, I need to still recover 1,000 more. I just need to recover 1,000 more out of the 3,000 that the fourth year would give me. In this particular case, it would be 3.33 years, or you can also say that 3 years plus 1 by 3 into 12, or 4 months. So 3 years and 4 months would be the payback period in this particular case. Right? I think that it is clear to everyone, similar to Abhishek. Any questions till now, till here, guys? To anyone? Okay. Now, what is the acceptance rule, guys? When it comes to payback period, what is the acceptance rule? Let's assume the organization is having a maximum acceptable limit of, let's say, 3 years. A standard payback period of 3 years. Then, will it accept the projects which are giving a payback period of more than 3 years? The answer would be a straight no. Why? Because the standard payback period is the maximum amount of time that an organization can give to any of the projects, right? Now Abhishek is asking, in case of multiple cash outflows, how do we say that, what is the payback period? So guys, Abhishek, in that particular case, we say that the cash flows are following a pattern of unconventional cash flows. In that particular case, the payback period would be considering the outflows as well as inflows, and cumulatively, whenever you are getting 0, that would be the answer. That is the year in which you are recovering your investment, right? Now the next technique that we would be doing is accounting rate of return. This is also a non-discounted technique. As the name suggests, it is the rate of return in terms of accounting. The formula is very, very simple. It is the average income upon average investment. Right? What do you mean by average income? Average income is the average net income that you are getting from the project, right? And average investment is the average of the initial investment and the closing value of investment. Let's take an example here. Let's assume the cost of the project is 40,000. At the start, earnings before depreciation, interest and tax from 1 to 5 years is given to you as the following. In the first year, earnings before depreciation, interest and tax is coming as 10,000. In the second year, it is coming as 12. Third year, it is 14. Fourth year, it is 16. And the fifth year is 20. Right? Now, guys, you know that you are also given that the salvage value of the investment is 0 at the end of 5 years. Right? You are also told that you need to charge depreciation as per SLM method, and the tax rate is given as 50%. If this is the information given to you, how would you calculate the accounting rate of return, guys? So guys, we are given earnings before depreciation, interest and tax as 10,000, 12, 14, 16 and 20. Firstly, I need to deduct depreciation. We need to charge depreciation as per straight line method. there's an investment of 40,000 which will be wiped out in 5 years. Salvage value is 0. So 40 minus 0 divided by 5 would be giving us 8,000 depreciation on a per annum basis. If I deduct depreciation of 8,000 on a per annum basis, I will be getting earnings before interest and tax of 2,000, 4,000, 6,000, 8,000 and 12,000 respectively. After this, there is no interest payment which is given in the question. That means our EBT is same as EBIT. Then comes tax. Tax is 50%, so EAT would also be 50%. If I deduct tax, I'll be getting earnings after tax or net income of 1,000 here, 2 here, 3 here, 4 here and 6 here. If you add it up, you will be getting a total net income over the 5 years as 16,000. But our numerator for getting ARR is average income. Average income means 16,000 earned among 5 years, average would be 3,200. This will act as your numerator. Coming to an average investment, which is the denominator, our starting point of investment, guys, was 40,000, which got to 0 at the end of 5th year when the salvage value has reduced to 0. That means we have used on an average the machinery at the starting of which the value was 40, but at the end of 5 years we are getting a value of 0. That means on an average, if we divide it by 2, we will be getting on an average the average investment of 20,000. With this, we will be getting our payback period as 16%. Very good, Abhishek. Is this clear to everyone? So guys, what is the acceptance rule? If the organization's minimum ARR is 15%, it will be accepting all the projects which are giving greater than 15%, right? If not, then the project would not be accepted, or it would be rejected. Higher the ARR, the better the project. Similarly, lower the payback period, the better is the project, because you are recovering your initial investment early, right? So this was all about the non-discounted techniques. Now let's discuss the very important aspect of capital budgeting decisions, which are referred to as discounted criteria, discounted evaluation criteria. Guys, a very a general and a very important and a very rational perspective to investing decisions is, or as a finance professional, a very rational point here is that if you are getting 100 rupees today versus 100 rupees a year later, 100 rupees after 1 year, which one would you prefer? Undoubtedly, I can say with surety that your answer would be 100 rupees of today would be preferred over 100 rupees a year later. Why? Because as a rational person, you know that you can invest 100 into one of the investment alternative, which is giving you a yearly return of, let's say, 10%, and can transform this 100 rupees of today into 110 a year later. So therefore, since for you the present value of 100 is similar to the future value of 110 after 1 year, you would not be preferring 100 rupees at the end of year 1 for the 100 rupees of today. As a rational person, you know how to compare these two, and you would be preferring 100 rupees of today over 100 rupees a year later. So this preference and this sense of comparing this present value with that of the future value 1 year later and preferring present value if both are in equal terms, this sense is known as time value of money. What you are doing is you are just valuing money as per the time. You are giving value of time to your money. You are saying that I will not be considering 100 rupees of today as 100 rupees a year later, because as a rational person, I know how to convert 100 into 1 plus r at the raised to the power 1 at the year 1. And this r would depend on you. How good are you at analyzing the investment alternatives and choosing the investment alternative based on your risk appetite? This R, guys, is the opportunity cost of capital, right? This R is your opportunity cost of capital. If this concept of opportunity cost of capital is not very clear to you till now, please ask me, I'll clear this concept as well for you. Right? So in this time value of money, what do? Is we say that present value of 100 rupees today would be equal to future value of 100 into 1 plus r raised to the power 1 at the end of first year. Right? So under time value of money, there are two things. One is known as discounting and another one is known as compounding. Right? The process of going from the present value to the future value by applying this formula that future value should be equal to present value into 1 plus r raised to the power the number of years is the process of moving from present value to future value by applying this formula to arrive at the future value is known as compounding. You are compounding, you are increasing the present value by compounding with the interest rate to get the future value. Similarly, the process of arriving at the present value from the future value like this is known as discounting. Both are same concepts. If you actually use this equation, you will be getting this answer only. So both are the same concepts. We will be utilizing these discounting and compounding techniques to actually come up with evaluation criteria under discounted techniques which are covered under capital budgeting decisions. Guys, till now I hope that everything is clear to you. If not, please ask, guys. Is there anything which is unclear to you? Okay, so let's come up with the discounted techniques. The first very important technique wherein a lot of questions are asked always is NPV. As the name suggests, it is net present value. That means we are comparing the present values and we are also saying net. Net is always considered as a difference. Now let's assume if I say that there's a share in the market which you can get for 100 rupees today. You say, okay, I'm interested in purchasing this share, but what will this share give me in the future? I say that it is estimated that you will be receiving cash inflows. So this is the cash outflow that you are doing at the starting of year 0. Right? I say that the estimated values of the dividends in the form of cash inflows that you will be getting from this particular share is 10 in the end of first year. And at the end of second year, again 10. You are having an investment horizon of 2 years only, and at the end of which you will be selling your share at a price P2, which is estimated as 105 as of now. What you will be doing is you will be comparing your present value of cash outflows, which is 100, with the present value of cash inflows. If you see 10, 10 and 105, these are in absolute terms and these are future values. This 10 you are receiving at the end of first year. This 10 and 105 you are receiving at the end of second year. Since these are at different time periods, as a rational finance person, you know that you cannot add it like this. There are two options. Either you can convert all of those into present value terms or you convert all of those into future value terms. What I'll be doing is I'll be comparing all of those in the present value terms because I am following a technique of net present value. If I compare the present value of the cash inflows, I'll be getting 10 upon 1 plus r raised to the power 1 because we know that present value is equals to future value divided by 1 plus r raised to the power n. In this case, n is 1 year because the future value is after 1 year only. But this 10 and 105 is the future value at the end of second year. Therefore, to convert it into present value terms at the end of 0 period is discounting by 2 years. Right? So that is why n here it will be 2. Now what you will be doing is you will be applying R, which is your opportunity cost of capital. If you are finding an investment alternative which can give you 10% return in the market, R for you would be 10%. For the questions in the exam, R will be given to you, but in the real life it is very subjective and depends on your own opportunity cost of capital. So let's assume we are doing these for exam point of view Let's assume R is given as 10%. What you will be doing is you will be comparing present value of cash inflows by doing these calculations, 10 divided by 1.1 and 115 divided by 1.1 square. And you will be comparing these present value of the cash inflows from this particular share with the present value of cash outflows, which in this case is 100. Guys, only if the present value of cash inflows is greater than the present value of cash outflows, it means that in present value terms you are getting some benefit, and only then you will be investing in this particular investment alternative. As the name suggests, net present value is the difference between the present value of cash inflows with that of the outflows. If this is positive, it means that PVCI is greater than PVCO, and you will be saying yes to this particular project. That means you will be accepting the project if NPV is greater than 0, and you will be rejecting the project if NPV is less than 0. You would be indifferent in both the projects, in any of the projects, if NPV is equal to 0. If you have any doubts till now, please ask me. Till then, I will be answering Abhishek's question that in ARR, why did not we divide 40,000 plus 0 by 5? Abhishek, the inherent assumption that we took here was that you have invested 40,000 at the end of at the start of year 0. Actually, if I do it like this, okay, let me do it here only. I'll change the color so that you can see it properly. Abhishek, यहाँ पर what you are doing is, we know that at the starting of 0 period your value is 40,000, right? That means at the end of first year, if you charge depreciation of 8,000, you will be getting the book value at the end of first year as 32,000. At the end of second year, the value would be 24,000. At the end of third year, it would be 16,000. At the end of fourth year, it would be 8,000. And at the end of fifth year, it would be 8,000. Sorry, at the end of fifth year, it would be 0. Now, if you utilize all of these figures and take the average, you will be getting 20,000 only. So, here since you are using 40 and 0, 2 figures only, therefore you are dividing it by 2. If you want to use all of these figures, you can definitely divide it by 5 as well. Abhishek, is this clear to you now? So this is the average investment. On an average, what you are using, right? Abhishek, clear hai ye? Please answer me if it is not clear. You can please ask your doubts if it is not clear till now as well. Guys, will you do a question on NPV? Should I give you a question? Okay, let's do this particular question. NPV ka, this is a question given to you. Your cash outflow is given as 2,500 at the starting of 0 period. Cash inflows from 1 to 5th year is given to you as follows: 900, 800, 700, 600 and 500. You are given your opportunity cost of capital as 10%. You need to compute NPV and suggest whether this particular project should be accepted or not. 10% is your opportunity cost of capital. How would you do this? Yes, very quickly do this question. So guys, what you will be doing is you will be writing your years. I'm just doing it in Excel because for ease of calculations, just that ways. We know that there are 5 years with us. What I'll be doing is I'll be marking the years. I'll be writing the cash flows. This is minus 2,500, 900, 800, 700, 600 and 500. I know that the opportunity cost of capital is 10%. So present value factor at 10% would be how much, guys, for me? It would be 1 divided by 1.1 raised to the power n. So So if I do this calculations of 1 divided by 1.1 raised to the power 1 here, 1 divided by 1.1 raised to the power 2 here, 1 divided by 1.1 raised to the power 3 here, 1 divided by 1.1 raised to the power 4 over here, and 1 divided by 1.1 raised to the power 5 at the last, I'll be getting the present value factors, right? With these present value of factors, if I utilize these present value of factors, then I'll be getting the present value of cash flows like this. This multiplied by the cash flows. These are the present value of cash flows, and if I take the sum, I'll be getting an NPV of 225.52. Is this clear to everyone? Okay, I'll just check with Rakshita. Why is the screen not visible to you guys? Just wait, guys. Is it visible now? Guys, is this visible now? Guys, is this visible now? I hope that it is visible now. Is it? Okay, I think that it is visible now, right? Chalo. Can you see me? Can you hear me, guys? Okay. So guys, let's start again. With this, we can find our NPV as 225.52. If my NPV is greater than 0, definitely I'll be going to accept this particular project, right? So since here my NPV is greater than 0, I'll go ahead and accept the project. Okay, now let's do the next technique, which is known as IRR. If there are any questions till now to anyone, please ask me. Okay. Any questions till now? Let's do internal rate of return as the next technique. This is also one of the most important techniques, internal rate of return. Guys, the name itself gives the answer that what do you mean by internal rate of return. Yeah, so Abhishek, in that particular case, maybe the present value factors would be given to you. Otherwise, they'll not be asking you to, solve this big question in the exam. So from the conceptual kind of clarity point of view, you should know, how to calculate NPV. And if a related question comes in the exam, you should be able to, answer this logically. No, I don't think so that the complex calculation involving questions would be asked in the exam, especially in the MCQ, right? So the next technique that I'll be doing is IRR, which is internal rate of return. As the name suggests, what is the rate of return given by the project is its IRR. Your opportunity cost of capital is, let's assume, 10%, right? This is your own opportunity cost of capital. That means you are competent enough to find the investment alternatives in the market which can give you a return of 10% on a per annum basis. Now keep this aside, you are having a project in hand, right? That particular project involves an investment of 200 as of now, and it will give 220 at the end of, let's say 225 at the end of first year, right? That means if you want to calculate the rate of return from this particular project, you know that 200 in this particular project will give a rate of return R. At the end of first year, it will generate 225. If you solve this particular equation, you would be getting 225 divided by 200, and you will be getting an answer of how much, guys? This would be 1.125. Inherently, you are getting a rate of return of 12.5%, because if you deduct 1 here on the right hand side, you will be getting 12.5% as your internal rate of return. Guys, what you are required to do is, you need to compare your opportunity cost of capital with that of the return provided by with this particular project. If you are able to generate greater return from this particular project as compared to your opportunity cost of capital, it means that it is a much more favorable project to you and it increases your wealth. Therefore, you will go ahead and accept this particular project. So if your IRR or rate of return is greater than your opportunity cost of capital, go ahead and say yes to a particular project. If not, then reject the project. If IRR is equal to your opportunity cost of capital, in that particular case, you might be indifferent in either accepting or rejecting, right? Because anyways, you are getting a similar rate of return from the market as well, right? So this was a simple example wherein the project involves only 1 year of investment horizon. What if the investment horizon is of more than 1 year? Let's take an example in which you are investing 5,000 at the starting of zero period and getting 4,000 and 3,000 at the end of first and the second year. Guys, can you calculate the IRR here? Can you calculate the IRR? See, such complex questions won't be asked, but just for your understanding point of view, I'm taking up these questions, and after explaining this, I'll be taking a numerical with you, and I would be wanting you to solve that correctly, right? That can be examined in the exam. So in this case, what would be the IRR? We know that IRR is that rate, the rate of return which actually equates. What have you done here? You have equated this particular thing. That means inherently, can I write it like this? 200 is equals to 225 upon 1 plus R? The answer is yes. I can rewrite this equation as this as well. In this case, we know that 200 is present value of cash outflows and this is nothing but present value of cash inflows. So IRR inherently is that rate of return which actually equates, which if you discount using that particular rate, it equates your present value of cash outflows with that of your present value of cash inflows, right? So here as well, for finding the IRR calculation, what you are required to do is, this is the present value of cash outflow. You need to compare this with the present value of cash inflows and you need to find that R which actually makes these equal in present value terms. So for that, you need to find R and get the answer. So let's assume that my R is 25%. If I assume a rate of 25%, let's use the Excel to get faster calculations. You know that there are 2 periods involved. My cash flows are 5,000. Okay, let me write minus 5,000 plus 4,000 and plus 3,000, right? If I'm taking 25%, what is my present value factor? It would be 1 divided by 1.25 raised to the power of the year. If I do so, I'll be getting these present value factors, and my present value of cash flows would be equal to this multiplied by this. What I'll be getting is, I'll be getting an NPV of 963 over here. Guys, that means if my NPV is a positive 963, if my NPV is a positive 963, that means my present value of cash inflows is greater than my present value of cash outflows. That means the rate of return that I have taken as 25% is less as compared to what the IRR of this particular project should be, right? That is why what I'll be doing is I'll be increasing the rate. Why? Because with 25%, my present value of cash inflows is greater. I need to decrease it further and equate it to 5,000, so my NPV becomes 0. To reduce it to a level of 5,000 so that my NPV becomes 0, let's take the rate of 30%. And with 30%, I'll be getting an NPV of how much, guys? I'll be getting an NPV by applying a rate of 30% as this. So right now, guys, my NPV is 963. If I apply a 30% rate over here instead of this, I'll be getting a different answer. Oh, I think I have applied 12% earlier. Then I'll be getting a minus of 147.9. So can I say minus 148? The answer is yes, right? So I'll be getting, at 30% I'm getting minus 148. At 25% what I'll be getting is, let's check again because I applied 1.12 by mistake. So if I apply 25%, I'm getting 120, a positive of 120. So if I actually do this in the graph, what I'll be getting is, guys, at 25%, my NPV was coming as a positive of 120. But at 30%, I'm getting an NPV of negative 148. Is this clear to everyone? From a positive NPV of 120, I am moving to the territory, a negative territory, and getting minus of 148 over here. What is IRR? IRR is that rate which equates our present value of cash inflows with that of present values of cash outflows and gives the NPV of 0. That means I am interested in calculating that point, that rate of return, where my NPV is equals to 0 or it touches the x-axis. I know that that particular rate of return would be definitely greater than 25% but less than 30%. What I'll be doing is I'll be applying linear interpolation method. I'll be saying that IRR is greater than 25%, but at 25% I am getting 120 positive NPV. I need to decrease this 120 to a level of 0. So this is the distance that I need to travel out of this total difference. That means a total distance is that of this much, from which I need to just cover 120 steps, right? And this distance has to be covered in how many steps? In just 5 steps. 30% minus 25%, 5% steps. So my IRR would be 25% plus 120 divided by 268. Among 268 steps, I need to cover 120 steps among the 5 percentage points. And with this, I'll be getting IRR of 27.24% as quoted by Abhishek rightly. So guys, this is the type of questions that are expected in the exam. Look, you will not be asked to calculate the IRR, but let me give you another question which is very, very important. Let's assume you are given this diagram of NPV and the discount rates, right? You know that your NPV is like this. You are given this particular rate, let's say at 12%. Here it is, let's say 15.2%, and here it is, let's say 17%. If your opportunity cost of capital is 16%, will you accept the current project or not? If this is the question given to you, what would be your answer? A very important and a conceptual question. If you answer, I will be, assuming that you have got the concepts very, very clearly. Batao, should you accept this current project or not? Should we accept this particular project? Okay, no. Abhishek is saying no. Any other comment? Very good, Abhishek. The answer should be no. Why? Because my opportunity cost of capital is 16%, but this particular project is giving me an internal rate of return of only 15.2%. In this case, my IRR is less than my opportunity cost of capital. Therefore, I should decline this project. Very important, very good and very important aspect is covered in this question. So Abhishek, well done. And this is how you need to evaluate the projects, guys, and say yes or no for your investment decision. Right? Rightly pointed out by you, Abhishek, that the desired rate is less than the actual rate that you are getting. The actual rate that you are getting from the project is just 15.2%, but the desired rate is at least 16%. Right. With this, we will be coming to the last technique of Profitability Index, PI. PI is also referred to as Profitability Index. Very, very simple, very, very easy, and it is very, very related to the NPV and the IRR techniques that have already been covered by us. Guys, if you want to calculate the Profitability Index, the formula is present value of cash inflows divided by present value of cash outflows. If you remember correctly, in NPV as well, the concept was very, very simple, that present value of cash inflows should be equal to present value of cash outflows, in which case NPV should be equal to greater than 0. If this is the case, you should accept the project. Here as well, to make PVCI greater than PVCO, your PI should be greater than 1. And if PI is greater than 1, you should go ahead and accept the project. If it is less than 1, you should reject the project, and if it is equal to 0, you should be indifferent when accepting or rejecting the project, because you are getting just your opportunity cost of capital that you could have realized elsewhere as well. So with these concepts, we are very, very clear with NPV, we are very, very clear with IRR and Profitability Index. In the non-discounted techniques, we have covered payback period and accounting rate of return. If you have any doubts relating to these things in the capital budgeting decisions kind of chapter, please do let me know. If not, you can please practice the questions relating to this particular chapter and see whether you have got something or not meaningful. Okay, with this, I'll take your leave. Bye-bye. Thank you.